And sentiment is souring after today's non-farm payroll publication. It's 311k instead of 200s of forecast. That's why the market has been in a turbulent mode and led us to a slump right after market open. So what does it mean in a short medium term, and how the Fed may respect that type of data? We'll publish this episode with the topics covered in a main spectrum of this transmission. So today's episode will be devoted strictly this kind of thing, and as well we'll debate about what's going on the technical side of many indexes. So without any further ado, let's get started. All right, and we are heading on and starting with economy view. So at first, maybe let's find out a bit more about US non-farm payrolls, and let's head to the details. So hiring was strongest in the leisure and hospitality sector, increasing by 105, with some market commentary noting that wages in the part of the economy were usually low, although the positions were now starting to be filled. In manufacturing, on the other hand, payrolls fell by 4,000, private sector rose by 265, and the rate of unemployment also came in a softer way than expected. So what does it mean for us? Right now, the Fed is considering rising an interest rate by 0.5%, and what I mean by he is Jeremy Powell, is driven by this data coming from the economy. Just look at this spectrum of non-farm payrolls recently, back during a year. Maybe take it in a line to depict it more clearly. So we can find that this slump after this recessionary period, as the fourth quarter was the one of where the GP was negative, we can find that we have rebounded strictly on January, and right now, even when correcting this wave, we are still below this 350, but over 250. So it means that it's giving us a power for the Fed to have their hawks positions to strengthen, and in my view, that may impact also on major indexes. If we just jump over to indexes, we can find that on SPX we are right now going downwards and trying to hit this level of 38.7, the next important support. But that's only medium term view. But look at this longer and a bit more particularly built pattern of head and shoulders, and that's the one that doesn't bode well for this index as a whole. So if we just find out and qualify this type of behavior, market behavior, as a left shoulder, head, and a right shoulder, we may have an objective for this type of formation right at the somewhere at the market, around the market trough, around 37 hundreds, with a possibility of getting to lower by 7% of this break of a neckline. So what it means for us, for investors, that right now bullish might be taken away of major indexes, and SPX may correct even further. We may see a possible rebound after a bit more dovish stance from Fed. That's not in sight as of yet. So this trough may collide with 36.4 thousand hundreds on SPX, and alongside US 100 also trying to find a bottom, and the bottom might be at least at 11.8, and considering that SPX is that bearish, we may get even to the levels of 11.5. That's still at least 2.7% lower from the point where we are right now. So that's already one of the points I wanted to cover right now. Let's head on to jobless claims. So despite jobless claims recently, initial jobless claims hasn't been that bad, and right now pointing that we are right getting out of the 200 points. Non-farm payrolls is right now one of the dominant gauge in terms of Fed to decide whether the policy may go in this way or that, and that's exactly the tendency that may go up higher, but that's just the analyst expectations that often getting to be faulty due to kind of a shaky outlook of a macro right now. So Fed for now might be predestined to grab this 0.5 rate hike on the 22nd of March meeting. All right, so we've already went through a market outlook. That's why I wanted to just jump to market movers. And what we got right here is, let me check. All right, so let's jump over to economic calendar. Economic calendar right now is for Friday almost full. We are still waiting for some of speeches out of the ECB, but this week has been the one of the most hawkish in terms of Fed's members' views on the economy. And right now, it's very important to reassess how the next week may look like. On Wednesday, we are waiting for ECB interest rate decision that will be difficult in some terms to swallow for the market, as we don't know that ECB is going to start up with the quantitative tightening somewhere since March. That's why that might be a catalyst for euro currency to grow, but this boost might be postponed for the time after Fed's meeting on 22nd of March, as it has the predominant meaning for market participants. So it's about just superficially about the next week. We'll cover this calendar in more particular way on Monday. That's why I'm inviting you to check it out next our transmission. And if you enjoy this episode, you may hit the like button. That also helps the algorithm to spread this type of content to larger type of audience. All right, so that's economic calendar right now. Let's find out what about earnings calendar. Why it is not loading up? Is it something wrong with web, with my network? Let's hang on a second. But all right, so we will go through this in a moment. Maybe it's Nasdaq side that's overloaded. I try to find out at investing.com. It's might have been packed with many ads that I don't like, but if we don't have a choice, that's the only one way to go through it. All right, so yesterday Oracle has published data that was a kind of a meeting expectations, and JD.com EPS has risen, but revenue has slided just a bit. So by and large, those companies has met expectations. DocuSign also have beaten them, so it means that despite the shaky outlook for the markets right now, this technology companies are pointing that they are more destined to rise in the nearest future, just after this Fed's policy will eventually be a bit more calm down. Right. So what we have about the next element that I wanted to cover, that's trade idea. And in terms of trade idea, let's find out what's going on with Palladium that I have pointed you to consider as a potential interesting investment in terms of trading. So XPD USD right now has tested thrice this congestion box, and I have mentioned about that XPD might be very good for short position somewhere around this level of 13.8 and 13.9 hundreds. Right now we are still consolidating within this area, but as we can find back in the past, this congestion area, this liquidity grab area was respected many times before, and I do expect that it will be that time as well, especially that we don't have a particular reversal or any type of pattern that may pivot XPD from falling. And right here, Palladium could be the one that may find another slash downwards right from this supply zone that is located somewhere around 13.7 and 13.75. If you are don't expect of XPD going to this level of 13.8 and 13.93, and that's where the perfect supply zone is located. You may start your position somewhere from here, but as always, reassess the risk you have to take. The bigger risk you have to take right when starting the position right here. But still, there is a chance for XPD to get to somewhere of those levels of 13.9 before reversing and going downwards even further. About the objective for this type of pattern, I do expect that we'll land something around 12.75. That's where another stop for XPD might be. So in this episode, that's everything. As always, all right. So one thing about summing up about this position. So I do expect that XPD should move like here with such the type of risk reward ratio at 3.61, and that's what I find a kind of a decent type of trade. All right, so we are already through with this episode, and today's one was a bit quicker than normal, but I hope that you found it kind of knowledgeable. So thank you very much for sticking around, and see you once again on Monday.